Imagine waking up to discover that one of the most essential metals in the global financial system is quietly disappearing from the shelves. Not because demand vanished, but because supply simply can't keep up anymore. And while most people are still distracted by stocks and crypto headlines, something far more fundamental is tightening behind the scenes. This is not a rumor, not a theory, but a signal flashing in plain sight as the US Mint suspends silver sales, raising a question that should make every investor pause and ask what happens next when the world's most trusted bullion supplier steps back and London, the heart of global silver trading, starts to feel the same strain. To understand why this matters, you have to understand what silver really is in today's world. Silver is not just a shiny metal for coins or jewelry. It is a critical industrial resource, a monetary metal with thousands of years of history, and a strategic asset sitting at the intersection of technology, energy, and finance. Unlike gold, which is mostly stored and rarely consumed, silver is used up. Once it goes into solar panels, electronics, medical equipment, and advanced batteries, much of it is never economically recovered. That single fact changes everything. When demand rises and supply falters, silver doesn't just get expensive, it becomes scarce in a way that paper markets struggle to reflect. Now let's talk about the US Mint. When people hear that the Mint suspends silver sales, many assume it's just a logistical issue, maybe a temporary pause or a manufacturing delay. But history shows that these suspensions tend to happen when physical demand overwhelms available blanks, the pre-made silver discs used to strike coins. The Mint does not mine silver, it buys it from approved suppliers. If those suppliers cannot deliver enough at current prices, production slows or stops. This is not about a lack of interest, it's about a lack of metal. And when the Mint pauses sales during periods of strong demand, it sends a subtle but powerful message. The physical market is tighter than it appears on paper. This is where the idea of a supply squeeze begins to take shape. A supply squeeze happens when demand continues to rise while available supply cannot respond quickly enough. In silver's case, supply is unusually rigid. Mining output grows slowly, often over many years, and most silver is produced as a byproduct of mining other metals like copper, lead, and zinc. That means even if silver prices rise, miners cannot instantly produce more silver unless those other metals are also profitable to extract. Recycling helps, but it is limited and often depends on high prices sustained over time. So when demand spikes suddenly, there is no easy valve to open. Demand, meanwhile, has been quietly building from multiple directions at once. Industrial demand continues to grow as solar energy expands worldwide. Each solar panel uses silver for its conductive properties, and global solar installations have been breaking records year after year. Add to that electric vehicles, 5G infrastructure, medical technologies, and consumer electronics, and you have a baseline of industrial demand that is not easily reduced. On top of that comes investment demand. When investors lose confidence in currencies, bonds, or financial stability, they turn to tangible assets. Silver, because it is cheaper per ounce than gold, attracts a wider audience, especially during times of economic stress. This brings us to London, the center of the global silver trade. The London bullion market is where massive amounts of silver are traded, stored, and settled mostly on paper. Futures contracts, unallocated accounts, and derivatives dominate daily volume. But beneath that paper system sits a finite amount of physical silver. When too many participants ask for delivery at the same time, the system strains. The market relies on the assumption that most players will settle in cash, not metal. If that assumption weakens even slightly, cracks begin to form. What makes the current moment different is that we are seeing pressure points emerge simultaneously. Retail investors report higher premiums on physical silver. Dealers experience delays. Government mints pause production. Industrial users lock in long-term supply contracts. These are not isolated events. They are symptoms of the same underlying condition. Think of it like a highway that appears clear from a helicopter view, but on the ground, individual lanes are slowly closing. Traffic still flows for now, but one accident, one surge in cars, and everything grinds to a halt. Historically, silver has experienced dramatic moves during periods when physical demand disconnects from paper pricing. In the late 1970s, inflation fears and currency weakness drove silver from single digits to nearly $50 an ounce. More recently, during the 2008 financial crisis, silver collapsed initially with everything else, only to surge several 100% in the following years as monetary stimulus flooded the system. These moves were not random, they reflected shifts in trust. When people stop trusting financial promises and start demanding real assets, silver reacts with speed and volatility. Another important factor is the cost of production. Mining silver is not cheap. Energy costs, labor, environmental regulations, and declining ore grades all push costs higher. If prices remain too low for too long, miners cut exploration and development. That sets the stage for future shortages. It's similar to what happens in agriculture. If farmers are paid too little for crops, they plant less the following season. The shortage doesn't show up immediately, but when it does, prices spike rapidly. Now consider the broader financial environment. Governments around the world carry record levels of debt. Central banks have expanded their balance sheets dramatically over the past decade. Inflation, even when officially reported as under control, remains a concern for everyday people who feel higher costs of living. In such an environment, precious metals regain relevance not as speculative trades but as insurance. Silver's dual role as both industrial necessity and monetary hedge makes it uniquely sensitive to these conditions. Critics argue that silver shortages are exaggerated, that there is plenty of metal above ground, and that futures markets ensure liquidity. There is truth in the idea that silver is not about to vanish overnight, but markets don't need absolute shortages to reprice. They only need marginal changes in availability and perception. If a small percentage of paper holders decide they want physical delivery, the imbalance becomes obvious very quickly. It's like a bank run. Banks don't need everyone to withdraw funds at once to fail, only enough people to test the system. So when the US Mint suspends sales and whispers grow louder about stress in London, it's not a prediction of collapse tomorrow. It's a warning signal. It suggests that the comfortable assumption of endless availability at stable prices may no longer hold. For investors, this raises practical questions. Do you understand the difference between paper silver and physical silver? Do you know how premiums work? Do you recognize how quickly sentiment can shift when supply chains tighten? As this situation develops, the key is not panic, but awareness. Silver has always been a metal of transition periods, moments when economic systems evolve and old certainties are questioned. We may be standing at the edge of such a moment now, where small disruptions reveal much larger structural issues beneath the surface, all building toward increasing pressure.